You are probably not failing at trading because you lack talent. You are failing because you are trying to force a noisy, unstable game into a fantasy of certainty. That is the real problem. Most traders do not lose because they cannot read a chart or memorize a setup. They lose because they confuse activity with edge, confidence with evidence, and a good week with a durable process. I take that seriously because the market punishes weak thinking faster than it punishes weak execution. The first mistake is psychological, but not in the fluffy sense people like to sell. It is a measurement problem. Traders look at a handful of wins and conclude they have skill, then look at a handful of losses and conclude they have a flaw. Both conclusions are usually too fast. In a market with high variance, short samples lie. A strategy can look brilliant for 20 trades and still be junk. A trader can look incompetent for a month and still be perfectly rational. If you do not understand the difference between signal and noise, you will keep rewriting your identity based on random clustering. The second mistake is that most traders do not actually know what edge means. They think edge is being right more often than wrong. That is amateur thinking. Edge is not accuracy. It is expectancy after costs, slippage, and execution errors. A setup with a 40% win rate can be excellent if the payoff distribution is favorable and the losses are controlled. A setup with a 70% win rate can be garbage if the average loss is larger than the average gain and the tail risk is ugly. I care less about how often you win than about whether the math survives friction. That is where most retail narratives collapse. Then there is the addiction to recent performance. This is where traders become their own worst backtester. They see a streak and start believing the market has changed in their favor. Sometimes it has. More often, they are just looking at a regime fragment and mistaking it for a law of nature. Markets rotate. Volatility compresses, then expands. Trend behavior gives way to chop. Mean reversion works until it does not. If your method only works in one narrow environment, your edge is not durable. It is seasonal. That is not the same thing. I also think many traders underestimate how much damage comes from overtrading. This is not just a discipline issue. It is an edge dilution issue. Every extra trade adds costs. But more importantly, it adds exposure to low-quality decisions. The market does not reward constant participation. It rewards selectivity when selectivity is backed by a repeatable process. If you are trading because you feel behind, bored, or eager to make the day count, you are not expressing an edge. You are paying tuition to your impulses. Risk management is where the truth shows up. A trader can be wrong often and still survive if losses are small, controlled, and consistent with the strategy's design. But many traders treat risk management like a moral slogan instead of a structural requirement. They size too large when they feel sure, then cut size too much when they feel uncertain. That is backwards. Position sizing should be boring. If your size changes with your emotions, your results will too. The market does not care how strongly you believe in a trade. It only cares whether your downside is contained when you are wrong. I am also skeptical of traders who keep changing systems every time they hit a rough patch. That behavior destroys the only thing that matters: evidence quality. You cannot evaluate a process if you abandon it before the sample matures. But the opposite mistake is just as bad. You cannot defend a broken method forever by calling it discipline. The question is not whether you feel attached to the strategy. The question is whether the data, over enough trades and enough regimes, still supports it. If the answer is no, loyalty is just denial with better branding. The real problem, then, is not that you are bad at trading. It is that you are probably asking the wrong questions. You ask, why did I lose this trade? When you should ask, does this setup have positive expectancy after costs? You ask, how do I stop feeling nervous? When you should ask, is my risk small enough that nervousness is not distorting my decisions? You ask, how do I make more money? When you should ask, what evidence would convince me this edge is real, durable, and worth scaling? Those are very different questions, and only one set leads to survivable improvement. My view is simple. Trading gets easier when you stop treating it like a test of intelligence and start treating it like a test of process quality. The best traders are not magical. They are selective, skeptical, and brutally honest about uncertainty. They know that a small edge, protected well, can compound. They also know that a fragile edge, scaled aggressively, can wipe out months of progress in a few bad sessions. That is the trade-off. You can chase excitement, or you can build durability. The market usually rewards the second choice, but only if you are patient enough to let evidence, not ego, do the talking.